Good morning. I'm Greg McKenna, and it's Wednesday, the 2nd of September 2015. I'm coming to you from an office I share in Sydney with one of the firms I work from, and it's been a massive night on markets overnight. Obviously, the stocks came under pressure in Asia yesterday, and that's fed around the world. We've seen European stocks under pressure, and then US stocks. It could have been much worse. We could have really seen 370 points, because what we're getting at the moment is difficult to tell, but overnight we saw an acute period of weakness. Interestingly, the bond markets haven't really reacted that much to the moves that we've seen in stock markets, and neither has gold. Gold this morning is at $1,139, and you would have thought normally that in a period like this you would have seen gold higher. But what we've got at the moment is we've got euro and yen rallying, so dollar yen's falling, and what we're seeing there is people are taking bets off the table as they usually do. So that's the safe haven status. What we've also got is the Aussie under acute pressure. It's broken a 14-year downtrend, as we've discussed recently, and I'll just bring up a chart of that so we can discuss it. But the key to these things, as we've seen in oil last week, is that what you get when you get these big breaks is you get a move lower. You often get then a recovery in that move, and then you see the price head lower eventually. So that's probably what we're going to see in the Aussie just at the moment. So if I share that screen with you, this dead air time's not very good, is it? So we can see here. So this is the 14-year uptrend line that's broken. So 70.72 at the moment. It's reasonable to think now, from a technical point of view, that the mid 60s, 65, 64 region, and then potentially 60, which is equivalent to the 2009 GFC low of 59.60, is where the targets are. What we've got, this is a monthly chart, obviously, so it takes a long time to play out. What we've got at the moment is we've got a convergence of bad news and a real change in sentiment. Over the last 24 hours, we saw that Chinese data was weak once again. We saw similarly weak data for PMIs in Europe. US PMIs were on the weak side. So we know that globally the manufacturing sector is under pressure, but it's been like that for a while now, hasn't it really? The service sector has been the key. In developed markets, most people live in a service economy. Most of the economic activity in developed markets. So that's. But yesterday, the big thing yesterday was that the NBS, the official Chinese PMI, actually printed below 50 for the first time in years. Now that is implicit recognition that the economy, or at least that sector of the economy, is going backwards. That seems to have had a big impact on traders, which, when coupled with what we saw in Europe, really hurt. IMF Managing Director Christine Lagarde also said that she's seeing unexpectedly weak global growth. And so what we've got this morning is we've got a 10% fall in oil. We've got, I thought that might have gone a little bit higher before it crashed, and I didn't think it was going to crash 10% in one night, but there you go. It's lower again in futures trade this morning in Asia. It's down another 3%, below 44 bucks. So it's looking weak. The S&P is looking weak. Dow's looking weak. The ASX, of course, is looking weak. The Aussie is looking terribly weak. But all is not lost. And if I can just summarize what we get in markets at the moment, we had a pessimistic crescendo at the lows of stocks last week. That set up the rally, which essentially within a few points satisfied my targets for the S&P 500, and then we've turned down again. So it's usual that we'd see this crescendo, pessimistic crescendo, rally, pullback. What the market's looking for, what traders are looking for, and what investors are looking for in a psychological sense, is they want to see if the buyers are still there. Think the Aussie dollar back in 2001 when we went to 47.75. We rallied and then we came back after the terrible events of September 11, but the Aussie found support again. that was a bigger picture view of what we're seeing now. We see it in markets all the time, even if it's on a 1 hour time frame, a 4 hour time frame, whatever time frame you're trading, markets that have a crescendo or a big fall in a very short space of time, that the base that we saw in the S&P 500 or the Dow, or oil last week, is really important for the near-term direction and the psychological outlook for traders at the moment. If I can just share my screen again, I'll show you what I mean on the chart of the S&P. So if we have a look at the S&P here, what we've got is we've got this big sell-off, this rally, and now we've had a decent sell-off again. Where we are now, so last week's level becomes the key. It's also key because what we saw last week was we saw that the low of the S&P 500 was also the low of the market back a while back, where it there was a test back late last year of the uptrend line that the S&P has recently just broken down and through. If you get the low taken out, shouldn't be scratching my nose, should I? If you get the low taken out, then we're in for a big fall. But from a trading perspective, and this is why I'm not supremely negative, even though I think it's a sell the rally rather than a buy the dip market. From a trading point of view, what you've got now is you've got a market that's just trying to find its base. So the jury's still out on that one. I'll have to keep an eye on it, but that's worth noting. If ever there's been a market ready and ripe for a turnaround, it's been the markets now, and there is a big chance that if that low goes, that we get the sort of negative feedback in prices that really do see the Dow fall, more than 1,000 points in a day and those sorts of things. Pardon me. If we look around the grounds, the Dow Jones was down 2.84%, the Nasdaq down 2.94%, the S&P down 2.95%. The FTSE catching up with the action, didn't do too badly really after a day off, only down 3.02%. The Frankfurt, the DAX lost 2.37%. We're on our way back to 9,000, which is my target was my target. We got there, and we'll go there again. I think the DAX is fundamentally breaking down and probably will lead. Shanghai's messy, and the government's finally showing signs that they're going to support the real economy for a change. ASX futures are pointing to an open this morning of down 60 to 70 points. We'll see how the pressure goes. The energy complex in Australia is obviously going to be under pressure, and we'll have to watch the banks, which were being sold last night. The Aussie dollar is in the low 70s, 70.20 odd. The price of gold's 11.39. The euro is up at 112 again, and I'm having trouble with my Reuters screens this morning. 112.96, so back up at 113. Safe haven status. Dollar yen 119.59. I still think that goes back to 116.5, which is what we talked about last week. The Aussie's going to head back into the 60s. So it's a difficult day. It's going to continue to be a difficult time for traders. We need to see some sort of circuit breaker. A lower than expected non-farm payrolls on Friday could be the circuit breaker that really takes the Fed out of the equation. There has been a lot of volatility in what the Fed's going to do recently, but it's a time for experienced traders to do what experienced traders do and just trade this market. But everyone else should really be careful about position sizing and risk and those sorts of things. Experienced traders need to be too, just that they've been doing it for longer, so they're more comfortable with it. These kind of markets have been happening all the time, and if you were brought up, in the early 90s and on Aussie interest rate markets and the currency and those sort of things, volatility is your friend. I really like these markets, but I know that they scare the heck out of some people. Anyway, that's it from me, Greg McKenna. Watch out for Australian GDP at 11:30 a.m. today. There's a small chance that it's a negative number and all hell will break loose on the Aussie if that happened. But in general, most forecasters are coalescing around the 0.5% mark. That would give us a year-on-year rate of around 2.2, 2.3%. Not exactly strong, and don't be surprised if you do see some focus on really weak nominal outcomes, which we're expected to see. So have a great day, good trading, stay safe, bye for now.